Just north of the river, you've got the university, UT, which is, I don't know, 50,000 kids or something. So there's a huge student focus just immediately north of the river. South of the river for us, it's a little bit more families, a little bit more residential.
Welcome to Target Market Insights, a podcast to help real estate investors navigate neighborhoods through the lens of local experts. Each week, we speak with local specialists to talk about their target market, useful tips, and the latest trends and developments. Location is the number one rule of real estate, and this show will help you identify best markets and submarkets for your investing. This is Target Market Insights with your host, John Kasman.
Hey, welcome to Target Market Insights. This is your local guide to real estate investing. We all know real estate is local, and this podcast is all about helping investors navigate the local landscape through the lens of the people that are helping to shape it. With that said, today we've got a very special guest. We have Andrew Campbell here today. Andrew is a native Austinite and real estate entrepreneur who, along with his brother, has built a $32 million portfolio of 276 investment units across Austin and San Antonio. He oversees capital improvements and rehabs across the portfolio, managing half of the units. He's an active and passive investor in multiple infill developments around Austin. Andrew is the co-founder and managing director of Wildhorn Capital, a multifamily syndication company focused on buying value-add properties in Texas. He also founded Blackwatch Tartan, LLC, which owns and manages the personal rental portfolio. By day, he has a background in market research and brand strategy, spending his time at advertising agencies, where most recently he was a partner at an award-winning app developer. Ladies and gentlemen, Andrew Campbell. Andrew, welcome to the show. Can you do us a favor and fill in any gaps that I may have had with the intro?
Yeah, John, thanks for having me. I'm happy to be here. I think you had it covered. That was pretty thorough.
All right, nice. Well, let's do this. Can you give us a little bit more about your background? I know you've got the market research background experience. Talk to us a little bit about that before we jump into the real estate.
Yeah, absolutely. I grew up in Austin and went to the University of Texas and got an advertising degree. When I was going to college, I really wanted to get a degree and pursue a career in something I thought would be a lot of fun. And it kind of led me down the advertising path. Spent about 15 years in advertising agencies and brand strategy groups doing research and insight gathering, trying to help better connect, brands with their audiences. And about 5 years ago, started buying rental properties kind of on the side. And that has turned into, everything you just read through and kind of consumed us and become our passion and recently left our jobs to focus on real estate investing full time.
Wow, that's amazing. I mean, to be able to leave your job is a dream for many people. Talk to us about how real estate investing actually helped you leave your job in the advertising field.
Yeah, it was a slow build. I mean, it took 4 or 5 years and we got into it knowing that it was going to be, it's a get rich slow program. But we dove in, very purposefully in buying investment properties in Austin. Started with a duplex and a fourplex and built up, from there, just kind of added cash flow and collected the cash flow. When we had enough money, we'd go buy another one. We did a couple of refinances and have just built the portfolio across Austin and San Antonio.
Awesome. So you went from a duplex, a fourplex, building a portfolio. That's a pretty major jump from a two and fourplex to 276 units. Can you talk to us a little bit about how you went from kind of that fourplex to the next largest property in your portfolio?
Yeah, it snowballed. It took us a couple of years. We were adding, a duplex, fourplexes. We really liked the idea of a fourplex, and the majority of the portfolio up until our most recent acquisition is comprised of fourplexes. We like those because we can get personal loans in our name because it's a 4 unit, and so we get 30-year fixed rate money. I think it's like 4.6% is our average across those. So we ran that play for, as long as we could. The end of last year, kind of latter half of last year, we did a big refinance across our portfolio, and that allowed us to go pick up a package of fourplexes. There was 8 of them, so that got us 32 units, and got us to the point where we felt like we had the flexibility to start thinking about leaving our jobs. And just left my job last month actually, and that coincided with the purchase of a 202 unit, which was our first syndicated deal that we did actually in Fort Worth, and that was a 200 unit deal. So it snowballed quickly. It took, several years to build it up, We kind of doubled the size of the portfolio last year from 30 to 70 units, and then we just did a 200 unit deal.
That's amazing. So you just gave us a lot to talk about there. You were able to jump from 4 units to jumping that up to 82 units of fourplexes. You said last month you left your job and, acquired 202 units. Let's talk a little bit more about getting the 82 units before we jump a little bit further. How
Sure.
were you able to take those fourplexes and snowball them from a fourplex to an 82 unit?
Yeah, it was, it was slow. It was buy a fourplex. We bought a fourplex and a duplex at the same time. And we actually had a few single family homes in there as well that we bought out of foreclosure. Then later that year, we had enough saved up off the cash flow to go put another down payment on a property. The following year, we just bought, I think two or three more fourplexes. And as we continued to build the portfolio, we'd save the cash flow and we'd, funnel bonuses from our jobs into our rental accounts, and we would just continue to buy. And so that was probably the first, 3 years. I don't know the exact numbers, but let's say we started off that first month with 6 units, a duplex and a fourplex, and it took us 3 years to get to around 30 to 35 units. And then when we did the refinance across the portfolio, we pulled out the equity. We were able to double the size of the portfolio with that package of fourplexes. That got us to like 72 units, and then the big purchase was the 200 unit.
Wow, that's amazing. I mean, so you use that equity in the properties, refinance, that allowed you to double your portfolio, and then you're able to acquire this 202 unit. So talk to me about how you got this 202 unit. I mean, that's a massive property for most people. How do you go from 72 units of essentially fourplexes to a 202 unit property?
Yeah, I think the short answer is partners. I think as we've moved into the syndication space and looking at larger properties and raising capital to go buy these, it's been about surrounding ourselves with good partners and folks that have been in the space that we can team with. And it's a team sport, and it's not something that we did on our own, but it was just a matter of finding good partners that we could lean on and leverage and learn from.
So you mentioned partners and you talked a little bit earlier about syndication. Can you just explain a little bit about a syndication and how that works?
Yeah, syndication, it's in its simplest form. It is us, going out as the sponsor and finding a deal. In our case, we like value add apartments that we can come in and increase the efficiency and fix them up, raise rents. And so our job is to go find those properties and put them under contract. And then we go work with investors to raise the capital and the down payment. You get a loan on the property, and it becomes a team sport where you and your investors then share in ownership of the property, and then we manage the turn and manage the day-to-day operations of the apartment.
So a lot of our listeners are interested in doing a syndication. What should they talk about with investors? What are investors looking for when you take them a syndication deal?
Well, I think the first thing they want to do is they want to look at your track record. They want to look at, what you've done in the past and who you are, kind of what your experience is. And a lot of that as you start out is just going to be personal relationships that you've got with, folks in your life, the friends and family network as you kind of pass that hat around. I think the second thing is, they want to see the details of the deal, and they want to see typically, what I find is they want to see your underwriting, or that they want to see a high level overview, that you have reasonable assumptions built in, and that you've got, you've done the due diligence so that it's very understood what the business plan is and how you're going to perform and achieve the returns that you're projecting.
Oh, that's awesome. So you're able to get that 202 unit and quit your job. How did you quit your job? I mean, was it once you got this 202 unit, you made that case, or was there something else around that?
It's kind of funny. It worked out. It was actually the exact same day. My last day at the job was the same day we closed on the property. I certainly didn't plan it to be, that beautifully aligned. It got to the point that, we've built up our portfolio to the point we had enough passive income coming in every month that felt like I was confident to go quit my job and pursue this passion, which is real estate investing. I think once we got that 202 unit under contract, gave me the additional confidence that this was the path that we were going to go do. And like I said, it just kind of a coincidence it happened at the same time. But we made the decision sort of end of last year that this year would be the year we'd leave our job and go do the syndication full time.
What was the passion behind that? What was the focus, or what made you so adamant about quitting your job this year?
it just got to the point as we started our investing career that I couldn't ignore this any longer, and I didn't want it to be a side hustle. When we bought our first property 4 or 5 years ago, it just totally changed the trajectory of our lives, and without even really knowing it. This is a business that I'm super passionate about, and I've understood how to build the business, how to manage properties, how to evaluate properties, and I can get my head around the totality of that business model. And then it's something that we get to build and do together, and I'm partnering with my brother in just having something that we get to build and see the wealth generation and the portfolio as it's growing. It's become a passion that kind of end of last year decided this is something that we want to go do together and build for the future, for ourselves and our families, and just kind of made that decision to do it.
And it's great that you're doing it with your brother. I invest with my wife, so it's an important thing from our family. We have other family members who invest with us as well. So as you talk about working with your brother, I mean that's definitely something that a lot of people are interested in. Can you talk about kind of the dynamics there, and how do you partner with your brother where you're able to maintain the family relationship, but then also the business relationship?
Yeah, no, it's been a fun ride. And when we started investing, we've always done it cooperatively, but we never actually partnered. So it was a little bit of a friendly competition. We would kind of compare notes and see, who was seeing what deals and what things we were going to buy. But it's something that brought us together, and we literally will talk every single day about real estate investing and about property managers and different properties that we see come on the market, and just kind of comparing notes along the way. And as we've both sort of fallen in love with the business, it just became a natural, hey, we should go, do this together. Let's, work together on it. Let's leverage each other's strengths and kind of define what those are. I think it's actually ended up bringing us together and closer.
That's awesome. So you guys started separately. You're investing, he's investing. It's more of a little bit of a brotherly competition at first, and then you realize joining forces might actually make it stronger.
Right. Right. And I think that friendly competition, actually fueled us. It's like, oh gosh, he just bought one. Well, I need to go, I need to keep up. I need to go buy one too. And that fueled the growth some.
Good to know that brotherly competition lasts well into adulthood.
Oh yeah.
Nice. So let's talk a little bit more about kind of your farm market, right? So this podcast is really all about helping people understand markets, whether it's their market or a different market. The key is learning how investors and others look at markets and look at market data is what's really going to help most of our investors get smarter about where to invest. So you're in Austin. I know Austin and San Antonio are kind of your focus markets, and you mentioned that competition with your brother. Were you guys buying properties in both markets starting off, or were you focused more so in Austin?
We started out in Austin, having grown up here, investing in your backyard and knowing the market intimately. We grew up in South Austin, and the bulk of our portfolio in Austin is all in South Austin. So we started there, and I think the first, 2 to 3 years, everything we owned was in Austin. We started looking in San Antonio when we felt like Austin was getting so hot and overheated that we couldn't find deals that would cash flow. And for us, that's rule number one. We can't buy something that's not going to cash flow from day one. We love appreciation, but aren't just going to bet on it. So we started with what we knew, which was Austin, and then as the markets have changed a little bit, we've expanded. We've got a fourplex up in Georgetown, which is 45 minutes north of Austin, and then everything else has been in San Antonio that we've purchased in the last few years.
So South Austin, talk to us a little bit more about Austin as a whole. You mentioned South Austin and Georgetown. Help us learn a little bit more about Austin as a market.
Yeah, I mean, I think everybody sees and reads about how fast Austin is growing, and it's always, once a week there's a headline about, best places to live and fastest growing and highest job growth. And so it's experienced a lot of change. It's largely driven by the highway that drives through the middle of town. It's kind of historically been segregated in some ways by the highway, and then there's a river, and so you're sort of north of the river or south of the river, and you're east of the highway or west of the highway. Our portfolio has all been south of the river, and I guess for the most part west of the highway. We have some stuff east of the highway as well.
So what is it about being south of the river and west of the highway makes that more appealing for you?
Number one is just familiarity. Again, we grew up south of the river and know those neighborhoods really well, and know the people that the type of tenant that you're going to get. And there wasn't anything really more sophisticated than that. There's plenty of great opportunities in neighborhoods in North Austin, and the suburbs there are growing like crazy as well. It just was, what were we the most familiar with, and what was the easiest to jump into this. When we started, we had zero experience, had never bought anything. We were going to manage these ourselves. So it was, what do we know? And that's kind of how we wound up there.
Okay. Talk to me about the tenant class that's in South Austin versus, or south of the river in Austin
Mhm.
versus north of the river in Austin. How does that differ?
I think there's obviously different pockets. Just north of the river, you've got the university UT, which is, I don't know, 50,000 kids or something. So there's a huge student focus just immediately north of the river. South of the river for us, it's a little bit more families, a little bit more residential. We have a large Hispanic population, and that typically is our kind of bread and butter tenant class. Most of our properties, I'd say, are B minus. We've kind of gravitated towards having a Hispanic based tenant class that has very low turnover, are great tenants, treat the place like their home. And, that's kind of, again, what we started with and just what we've gravitated towards because it's familiar, but it's worked out really well for us.
That's awesome. And how does that, with your target audience for the south of the river, how does that help you win in that market? How is it helping you to be a little bit stronger versus some of the other tenant classes?
I think the biggest thing that we like and what we've been able to manage in our portfolio is we've had extremely low turnover. We have some properties that, in 4 and 5 years have had no one leave, and we've been able to raise the rents, kind of keeping just below market, but, aggressively raise the rents every year. And I think, again, it comes back to our tenants treating it like their homes. We're going to take really good care of the tenants and keep it fixed up and operating, like a home. But we kind of seek out properties or tenants that have little bit more of a family element, that have some young kids, and we know that they're going to move there and they're going to be there for 2, 3, 4, 5 years.
That's a great point. So for Austin or kind of any market, one of the great tips there is, as you're looking at rental units, look at places where you can attract families, as you'll see lower turnover.
100%. One of the things we look at is, prefer to buy places that are 2 or 3 bedrooms versus a 1 bedroom. I think, conventional wisdom, and certainly we've seen this play out, is, 1 bedroom, you're going to get a single person, maybe a couple, and you're going to get higher turnover, annual turnover in those units, where we see, families typically will stay longer is what we've seen.
And as you're investing at this point, you were still doing this part time. So having that lower turnover really led to probably easier management. Is that correct?
Absolutely. Easier management, it's easy to go get a renewal. And it also just, financially, it just drives the business. Turnover is just kill you if you've got to go in and, pay somebody to relet it, or you got to go fix up and spend, $1,500 to get it ready to lease up again. That could wipe out a whole year's profits on that particular unit. So that's kind of been our philosophy, is keep the rents just below market and avoid turnover. And it's going to be for us, at least so far, it's been a very, very successful business.
That's awesome. So we know Austin's on fire as a market. Where exactly is kind of some of the up and coming areas, or where are investors really starting to look at in the city of Austin?
Yeah, I think that's a really interesting question, and something I talk with people a lot about is they want to get into Austin. It's like, well, you got to define what your criteria are and what you're looking for. I go back to, for us, we only want to buy things that cash flow, and I don't feel like you can find those things, or we have not found those things in the last couple of years. It's tremendous appreciation, and we've benefited from some of that. I think the areas that we've been looking at are a little bit more on the outskirts, or even into San Antonio. In Austin specifically, I think you see a lot of growth north and northwest and into the suburbs. Cedar Park and Round Rock. South, the suburbs of Buda and Kyle are booming. But I think the further you get away from the city, the better chance you've got to see some cash flow. The flip side of that is, the stuff on the interior is getting some just crazy appreciation in it. And if you can, I think what I'm seeing, most of the buyers on the properties we look at seem to be out of state and, looking for that appreciation, or they have 1031 money and, are okay with a slight cash flow loss every month, banking on the fact that, close to downtown is going to continue to appreciate.
That was great. And that's interesting news to keep in mind. I mean, to your point, you have a lot of out of state dollars looking to invest. You have people who may be looking to park money long term. So they're less interested in kind of the day-to-day cash flow as they are in the appreciation. So if you are looking for cash flow, maybe looking just along the outskirts of the core of the major market is a great place to start.
Yeah, and it's one of the things that drove us to looking in San Antonio. San Antonio's hour or so drive from Austin. We spent a lot of time there growing up. Going down to a Spurs game or hanging out the Riverwalk. So knew the city pretty well, but I feel like it's a market that you can still go get things that will cash flow. It is, it's appreciating, not as explosively as Austin, but it meets our criteria a little bit better.
That's great. So talk to me a little bit about San Antonio. I mean, so you've been investing in San Antonio for how long now?
We've been down there for, I'd say, 2.5 years.
Okay, so as you were in Austin looking to expand, San Antonio fit your criteria a little bit better. Where exactly are you looking in San Antonio?
We've been looking all over. I think again, you can kind of segment that city. A lot of the growth is happening north and northwest, out towards the hill country. And if you look out towards Bernie, you see some just really explosive pockets of growth. We actually have a few offers in on some larger apartment buildings that are kind of in that northwest quadrant. And I think that's experiencing good growth. There's a big medical center there, and you get good class of tenants. We actually own a lot of about 20 units or so, I'd say, that are in South San Antonio, which again, it's not growing as fast, but I think it's, for us, it's a long-term play. They're relatively close to downtown and they'll see some appreciation, but it fits that tenant class again. It's South San Antonio tends to be a little bit more Hispanic, a little bit more family oriented. So we've had very similar luck in attracting families that have not turned over, and it's just becomes a very stable, steady business for us in those units.
That's awesome. So you've had a lot of luck and success really identifying those family oriented communities and investing there, knowing that, they're going to stay there. You can deliver strong cash flow, maybe not as much upside on the appreciation, or at least not immediately, but you've got the strong cash flow there.
Yeah, absolutely.
That's awesome. Awesome. So are there places in Austin that you would avoid, or places you just think, hey, you know what? I would not invest in those locations?
That's something that we talk about a lot, Mark and I, my brother. And I think depending how you want to look at that question, if you want to look at it from a cash flow standpoint, we have a lot of debate. Well, I thought that 2 years ago things were super overheated and overpriced, and today, they're worth $150,000 more than they were worth 2 years ago. So I hesitate to say no, you shouldn't buy in Austin, because I think it is going to continue to appreciate and it's well suited and positioned to weather any sort of downturn that's certainly coming. So I think on that front, there are certainly areas. I think if you look at the 78704 zip code is one that's wildly popular and seeing lots of development and lots of infill, you know, tearing down an old house and putting up a 2-unit duplex or a lot of new A-class apartments. I feel like it's very expensive, but at the same time, I think it's seeing, some of the most rapid rates of appreciation that are out there. So it's tough for me to answer that question. There's things that we're not going to buy right now because it doesn't work for our model, but there are absolutely folks that are, buying in these really expensive zip codes, but they just continue to go up in price.
Well, I think what you said though is still very important, right? So it's you guys have a model, it's working really well. So if that is cash flowing properties that attract families, just jumping into that 78704 zip code because it's hot might not deliver the returns you're looking for. So it's important to stay focused on what your objective is and what your model is, as opposed to just chasing a hot neighborhood.
Yeah, absolutely. And that's where I say, hesitate to answer that question a little bit. I always ask people, well, what are your investing goals? Where should you look? It kind of depends what your goals are. Do you want to go to a little bit lower growth, lower socioeconomic part of the town, and look for some cash flow and be, okay with a little bit more turnover or a little higher management costs? Or do you want to go into, 78704 and, bank on it appreciating? I'll give you an example. We actually bought a fourplex in 78704 about 2 years ago. We paid $380,000 for it. And at the time, I was cringing. That was the most we had paid for a property by almost $100,000. But it was a good location. I knew it was just going to break even on the cash flow or make a little bit of money every month. And it was a bit of a bet on appreciation. And at the end of last year, when we got it appraised, it appraised for $500,000. So we've certainly dabbled in it, but it's just kind of a crazy market.
Well, To your point, you can take those risks, and I think if you have a portfolio and you've built it up, that's when you can start taking calculated risk. If you're starting out, it probably makes more sense to stick to the criteria, build it up, make sure you understand what you're doing before you start swinging for the fences a little bit.
Yeah, I would agree.
So let's switch gears a little bit. I want to broaden this out to folks who maybe aren't as interested in Austin, San Antonio, and Texas, even though we know that it's its own country as it is. But
Absolutely.
if you were starting in any new market, so you mentioned Dallas Fort Worth is where you purchased a 202 unit with some partners. How do you approach a new market that you're unfamiliar with?
I think you start with just doing a bunch of online desk research, and that's actually a process that we've done here in the last few months as we've looked at, markets to go look for apartment deals. You can get a ton of great info online, Department of Labor and Statistics, looking at job growth, population growth, what the trends look like the last, 5 years, looking at how diverse is the employment base, just spending some time on Google Maps, on apartments.com, kind of canvassing the different types of neighborhoods and the different types of properties that are located within those. I think that's a great place to start. And then I think you just have to spend some time there and build up relationships and, fly in or drive in and have some meetings set up with some brokers or go to a local meetup to meet some folks that are there. I think it's super important to have, kind of local boots on the ground and expertise, if you're going to look at entering a market that, is not local to you.
And who do you start with? Do you start with brokers? Do you start with meetups? How do you set up those meetings when you're looking to go into a market and setting up some meetings with some of the locals?
Yeah, I've started with brokers traditionally, just kind of look up who's active, kind of network my way around and then just start emailing people and set up meetings. Say, hey, I'm going to be good example. I'm going up to Dallas next week to spend some time and largely we're going to look at a couple of properties, but it's largely aimed at building relationships. So I've got, a handful of meetings set up with different brokers that, maybe I've talked with, but I haven't met in person or, want to make an introduction to. They're going to be your best source of deal flow and, kind of learning. You give them your criteria. This is who I am. This is what I'm all about and the type of properties I'm looking for. And they're going to be able to guide you to other people in the market and potential investors and also just give you a sense of, hey, these are the areas you're going to want to look in, the neighborhoods that where you'll find that type of property.
That's great. Those are great tidbits, especially when you talk about giving them your criteria, because that's going to be important to the points you made earlier. If you're looking for family oriented, places, that's going to be very different than going to a place that has strong appreciation. So making sure that you have some criteria to help these brokers or whoever you're talking to guide you is definitely an important part of how you want to approach these conversations.
Yeah, absolutely. I mean, the way I kind of look at the broker angle, it's their job to build these relationships and they've been in these markets for a long time. And if you're coming in there as a new investor or a new buyer, leveraging the relationships that they've built and the local market knowledge that they've picked up is a really good way to sort of jumpstart your education.
Excellent. So when you talk about learning that market, and we've talked a little about a market being hot, right, or Austin being too hot, outside of cash flow, is there any other data point that you look at to help get a read on whether a market's going to deliver the types of returns that you're looking for?
Cash flow, and then, what does rent growth look like? What is the overall sort of occupancy and trends in the market? And I think that's the one thing I struggle with Austin right now. The rents are growing 7, 8, 9, 10% year over year consistently for the last several years. The occupancy remains super high. There's still a shortage of total housing units. Again, it's tough to say, well, it's not a good place to invest. It doesn't right now fit our model. But I look at what rent growth projections look like, and you might look at a place that, all right, year one or year two it's going to break even, but if rents continue to grow like that, I'll be right where I need to be in year three cash flow wise, but maybe I will have picked up a bunch of appreciation. I'll be able to leverage that.
Nice. That's great. So what do you do to stay on top of the market and stay on top of the changes in your markets?
Just reading, networking. I'm a big fan of the business journals, the Austin Business Journal, San Antonio Business Journal. Setting up, we've got some alerts set up on, from Google, getting emails on things, and again, kind of back to networking. Just spending some time with brokers. That again, it's their job as much as yours to stay on top of these trends and the different neighborhoods and the developments that are happening. And as you kind of build relationships with them, it just sort of everybody shares the information they've got.
That's awesome. So you talked about rent growth, trends in the markets, helping you stay on top of it, looking at the Austin Business Journal, networking, setting up those Google alerts, great ways to kind of stay on top of what's happening in the marketplace. And then last one for you. What's the one thing you do daily that kind of helps you stay focused on your goals, especially with you and your brother?
Yeah, the thing it actually started it here just in the last couple of months as we've ramped up the leaving our job and having this new sort of freedom and flexibility. It's writing out my schedule and my goals for the day every day, just in a paper journal. The night before, I will kind of write through what do I need to do today, who do I need to talk to, sort of not necessarily a schedule, but just writing out what are my goals for the day and give myself the a checklist, a to-do list, if you will.
That's awesome. So, Andrew, where can people learn more about you and get in contact with you?
Yeah, you can go on our website. It's www.wildhorncap.com. You can email me at andrew@wildhorncap.com. If you go on the website, there's a button. Some of the stuff we've talked about, I wrote a sort of step-by-step process and a report on how we built our portfolio and the keys to our success. And if you go in there, send me an email. I'd be happy to send that to you.
That's awesome. Wildhorncap.com. Andrew, thanks again for your time today. Great information on Austin, San Antonio, and a little bit on your other markets as well as you're looking to grow. Austin, you gave us some great nuggets on both of those markets, a little bit on Dallas, Fort Worth, and what you're doing to stay on top of it. So you're reading the Austin Business Journal, you're reading about the San Antonio Business Journal, using those Google alerts, checking stats from Department of Labor and Statistics, understanding what's going on in that market, and then really staying focused on where you get those families, those family-oriented housing to make sure you keep your occupancy high and keeping your turnovers low. So thank you again for sharing all this great information with us today, and I look forward to staying in touch and talking to you soon.
Yeah, thanks a lot, John. I appreciate it, and we'll talk with you soon.
All right. Thank you for listening to this episode of Target Market Insights. Now be sure to subscribe on iTunes, Stitcher, or Google Play, and check out our previous episodes at targetmarketinsights.com. If you like this show, please leave us a 5-star rating and leave us a review as well on iTunes or Stitcher. These reviews and ratings will really help us get the word out to other people. So it's really important, if you're getting some great value from the podcast, just leave a review, leave a rating so we can share that with other listeners as well. We're actually going to be doing something special and giving away a copy of The Best Real Estate Investing Advice Ever, Volume 2, written by Joe Fairless, a guest of the show. So we're going to give that away to one of our reviews that we receive. And then we also have a copy of Get Paid for Your Pad by Jasper Ribbers. We're going to give away a copy of that book as well. So leave a review. Let's get some great content from some of the people who we've had on the show. And we'll continue to try to serve our community and make sure that we are providing as much target market insights as possible. Till next time, have a great day and we'll talk soon.